Chapter 10 focuses on liabilities. So let's review. We know that assets equal liabilities plus stockholders' equity. And we can think of assets as the resources of the company. It's the things the company owns, essentially. And then on the other side, really the liabilities, which are obligations we owe to our creditors, and stockholders' equity represents our investors. Those are their rights to the assets. So we have assets that are our resources, and we have creditors that have rights to the assets, and we have investors that have rights to the assets. So we could say then that liabilities are the creditors' claims on these assets, or total assets. Liabilities, though, also reflect obligations of the company, because those obligations are going to require future sacrifices. So let's go through an example of that. So if we have an obligation of an accounts payable, right, that's because we purchased goods, right, and we haven't paid for them. So what creates accounts payable is we purchase goods on account, and we owe money for it. And in the future, we're going to pay cash for that, or write a check for it, in other words. So the future sacrifice is we give up cash, and of course cash again can represent our checking account in the bank. We can also have liabilities, like utilities payable, that represents the usage of something. So we've used the utilities. This could be salaries payable, where we've used the salaries, but we haven't paid for it. So we have a liability because we've used something, but we haven't paid for it. And then in some time in the future, we will pay for it, and that's going to be the sacrifice, that we give up cash for it. Now, another type of liability that we have seen is this idea of unearned revenue. Now, unearned revenue is where we provide goods and services in advance. Excuse me, let me say that wrong. Unearned revenue is when we collected cash in advance from the customer and we owe goods and services. Again, the customer prepaid us, so we received our cash, but we haven't delivered the goods and services yet. So we owe goods and services. So in the future, that's what we're going to give up, goods and or services. Okay, so that gets through definitions of liabilities. Let's look at our classifications on the balance sheet. And we already know that we have the two classifications, current and long-term. Current generally means that the liabilities will be paid within 1 year. We know in accounting, usually the break-off between current and long-term is a year. So when we make the payment in the future, that's usually going to come from our current assets, which would usually that's going to be cash, as we saw here. But it doesn't have to be cash. We can see that it could have been our merchandise inventory. We give up our goods out of our merchandise inventory. So it could be some other kind of current asset. It also could be that we don't really give up a current asset. Instead, we just sort of refinance and create another current liability. Okay, so let's go through an example of differentiating between current and long-term. Let's say we have a $5,000 note payable, and it's due in $1,000 principal payments over 5 years. So we're not factoring interest payments here. We're only looking at the liability for principal. So if $1,000 is going to be paid next year, so within 1 year we will pay $1,000 principal. That makes this the $1,000 a current liability. And then the remaining $4,000 will be paid in year 2, 3, 4, and 5, all the way through year 2 through 5. And that makes that long-term because it'll be paid after a year. So that gives us an example of how we can have one liability that's actually part of its current and part of its long-term. Okay, now going forward in this lecture, let me just say this up front. We have covered a lot of the content that's in Chapter 10. We've already covered it throughout the semester. For instance, these things, payables, unearned revenue, we've already seen this, but your book in Chapter 10 will repeat it and will review it for you. So I'm not really going to lecture on those particular topics. I'm actually just going to lecture on a couple more, well, actually 3 topics that are kind of unique. And we haven't seen, either we haven't seen it or we haven't seen it too much. Okay, so one of those first topics would be notes. Now, we've already gone through, I've got a demo problem where we have a company received an $8,000 6-month 6% note to settle an unpaid balance. Now, we went through this and looked at this situation as a note receivable. So when we went over accounts receivable, we also discussed notes receivable, and this was actually the demonstration problem that I used. So we would have, recorded, notes receivable would have come in, and we would have decreased accounts receivable for that $8,000. And I've got that, on the next page, and we'll go over that here in a little bit. Okay, and then 2 months go by, right? November and December go by. It's the end of the year, and we have to accrue interest. So our calculation for interest is principal times rate, which is 6%, times time. Now, even though this is a 6-month note, when we enter in interest rate in this formula as an annual interest rate, then when we record time, it also has to be based on a year. So if we're using, which we do, we use an annual interest rate. It doesn't matter that it's a 6-month note. The calculation for interest is based on annual, because this is the annual interest rate. The 6% is not a 6-month interest rate. It's an annual interest rate. Okay, and so we would have solved for $80 of interest would have been earned in 2016. So we would have accrued that, and I'll go over the entries here in a little bit. Now, then it'll be 2017. So we start a new year. So in 2017, right, the remaining 4 months, right, there's 2 months in 2016. There are 4 months in 2017. So then we calculate the interest that applies to 2017. 4 months apply there. So we'll see that the interest earned in 2017 was $160. And so total interest over the life of the 6 months is $240. But of the $240, 2 months or $80 is earned in 2016, and 4 months, which is $160, is earned in the next year. Okay, so let's take a look at when it was a receivable, what happened. So we can see that we decreased accounts receivable $8,000 and notes receivable came in of $8,000. And then at the end of the year, we accrue an additional $80, which remember was the 2 months interest. So we haven't collected that $80, so we put it in a receivable and record interest revenue. So let's look at, we got rid of the account receivable. So when we go to the balance sheet at 12/31/16, we're going to have both a note receivable of $8,000 and interest receivable of $80. So let's go take a look at that. So we can see at the end of the first year, we have the note and interest receivable for $8,080. We also, at the end of 2016, record interest revenue of $80, and that will go on the income statement for the first year. Now let's go look and refresh our memory of the entry for April 30th in 2017. In 2017, we earned 4 months interest revenue, so we record that. Now, also, if we look at the balance sheet, we had an $8,000 note receivable, but, after we collect that in full in 2017, we won't have a balance. So the note receivable went down $8,000, right, so we credit that. And likewise, the interest receivable, after we collect our money, we won't have any of that left over either at the end of 2017. So we reduce notes receivable for its balance at the end of 2016 and reduce interest receivable for its balance. So these two go down. And then we record 4 months of interest. And then recall I said, right, 160 and 80, we collect interest at 240, and then the other amount here is the principal of $8,000. So cash comes in, right? Cash comes in of $8,000 for principal and $240 for interest, of total 6 months interest. So we collect 6 months interest. Of that interest, 4 months is earned in 2017, and 80 was earned last year and put in this receivable. Okay, so that goes through and shows us this situation with interest receivable. Now we're going to go look, well, what if, we had been, it had been a liability. So if we were the debtor, we would be, right, reducing accounts payable by debiting it and increasing notes payable by crediting it. So we're just going to take $8,000 out of accounts payable and put it into notes payable. Then at the end of the year, right, 2 months have gone by, we have incurred $80 of interest expense. We haven't paid it, so we owe it. So when we go to the balance sheet, we'll have a note payable of $80,000. We'll have an interest payable of $80,000. So let's go put those in. At the end of the first year, $8,000 and then $80,000. We also will have incurred interest expense, right? We're the debtor, so our cost is interest expense. So we'll have this $80 of interest expense. So the numbers are the same as the seller, but we're the debtor, and so it's a payable instead of a receivable. It's an expense instead of revenue. Now let's go to our second year. So 4 months go by. We have incurred 4 months interest, so $160, right? Twice as much. And we're going to pay off our payable. So when this is all said and done, we won't have a note payable, and we're also going to pay off that interest payable. So we want to get rid of the $8,000 note payable. Excuse me, down the wrong side. $8,000 note payable, so decrease it, and decrease our interest payable. So those normally have a credit balance. We debit them to zero those out. Okay, total cash paid will be, right, our $8,000 of principal and our $240 of interest. Okay, so interest expense this second year, $160. So again, let's recap that. We started with an $8,000 note payable as a credit. We debit that the second year to zero that out. At the end of the first year, we created an interest payable of $80,000, but in the second year, we debit that to zero it out. At the end of the life of the note, we owe principal of $8,000 and $240 for interest. And also, at the end of the life of the note, in 2017, 4 months went by. 4 months of interest cost is $160. Another topic that we have not seen is payroll. So I'm going to use exercise 5 as a demo problem. If you can't see it too well here, actually it's on the handout, or you can turn to your book for exercise 5. In exercise 5, it tells us information about payroll and asks us to make journal entries for payroll itself and then for the company's payroll tax expense. So let's look at the first part. In the first part, the narrative tells us that there are wages of $64,000. So total wages are $64,000. And then in those wages, we actually are going to withhold, the employee has to pay FICA, and so as employer, we will withhold that from their salary, and then we turn that over to the government. So there will be federal FICA, which is Social Security, and so we have to hold that back. We do not give that to the employee. We will subtract that from the amount we're going to write a check, and then we turn around and pay this to the government. Also tells us that we're going to withhold for federal income tax. And that was $7,500. And then in addition to that, we're going to withhold state income tax for the various employees, state income tax of $3,100. Okay, and then also there are union dues, and we withhold that, and then we will pay those for the employees. So we withhold them from their payroll checks, and then we'll turn that over ourselves. So our net amount paid, right, the net amount that we're going to pay is this 48,104. So if we were to make a journal entry for this, it'll look something like this. We'll have like salaries and wage expense. I'm going to abbreviate expense. The total expense is $64,000. And then our credits will be for all of these. So we withhold it, but we owe. We're going to turn around and make these payments. So we're going to have a credit for FICA. So we'll have FICA taxes payable, and I'm going to abbreviate the payable, PAY. So FICA taxes payable, $4,896. We'll have federal income taxes payable. So I'm going to abbreviate that. Federal income taxes payable, $7,500. So FICA taxes payable, federal income tax payable, and then state income tax payable. So we just create liabilities for all these until we actually make payment to these different places. Okay, and then union dues payable. Again, I'm just abbreviating payable as PAY. And then the net amount, eventually we will credit cash, but we'll put this into payable first, and then we'll turn around and pay it. So salaries and wages payable. I'm going to have to abbreviate to get that in. That's the 48,104. So we have our debit and then our various credits. 48,104, by the way, if you can't read my writing. And then we'll turn around and eventually all of these payables will be debited and cash will be credited accordingly for each of these amounts as we write checks to each of these. Okay, now that is for paying, wages for employees. Now, in addition to that, the employer will have taxes that the employer has to pay. So let's go over those. First off, so let's look at, what are the costs for the company? So the company costs, and when I say this isn't payroll, this is actually for payroll taxes because it's asking us for payroll tax expense for the company. So the company costs, well, first off, this Social Security, the FICA, the company has to match that dollar amount. So the employees are going to owe $48.96, and the company turns around and has to also pay $48.96. So the employees pay this, and the company also will match that and have to come up with cash for this. Now the other thing up here is we have state unemployment tax. That is for the employers only. So again, the company or the employer has to pay the state unemployment tax. Employees do not have to pay that. So only the employer, not the employees. So state unemployment. $700. Okay, so $55.96 is the total payroll tax for the employer. Total payroll tax for the employer. So if we look at this, we're going to have payroll tax expense. Payroll tax expense. I'm going to abbreviate expense, EXP, to shortcut that. And that's going to be the $55.96. So total payroll tax expense is $55.96. And then we'll have our payables. We'll have FICA taxes payable, $48.96. And then state unemployment tax payable, again, kind of abbreviating some of that, but the state unemployment tax payable, there's our remaining $700. So much of then this issue with payroll taxes is really your understanding about how payroll taxes function. Okay, and then our last topic has to do with bonds. Bonds are debt. And so they just sort of function a little bit differently, though, than a note. And the difference is because a company will actually issue bonds in the bond market, and there could be hundreds or thousands or millions of bond holders or creditors. So again, instead of just going to the bank and borrowing money, we actually go to the bond market and borrow money from lots and lots and lots of different people and entities. So there will be a price for the bond. So let's go through my example. We have a $100,000 bond, that's the face of it, and it sells at 100. 100 means it sells at 100% of its face value. And face value just means the contract. On the face of the contract, what's the dollar amount? So the face value. So in this case, we're borrowing today $100,000. And the bond's going to pay interest annually, and then it'll mature in 5 years. So here's going to be, we borrow $100,000 today, we'll pay interest of 8% each year, and then at the end of the 5th year, we'll pay the principal back. So in the year that we issue the bond or we borrow the money, we're going to get $100,000, right? And we'll put $100,000 in the bond payable. So what happens then is that each year, right, we're going to have these $8,000 payments. So we'll have interest expense and cash going out each year, so making that payment. So if I were to set this up on a schedule, you know, we've got $8,000 interest expense each year. So each year, 8, 8, 8, 8. So $8,000 for 5 years. So I'm putting this $8,000 of interest expense and just showing it here. And that's the full interest payment. So if we put $100,000 in bonds payable, and we started with that, there are no principal payments. So each year, the ending balance for the bond is going to be $100,000. So we pay interest, so we don't owe interest, right? Unlike the note we saw earlier, unlike that note, we will not have interest payable because we make payment on interest each year. Now, so at the end of the first four years, we'll have $100,000. But keep in mind, at the end of the 5th year, we're going to make a $100,000 payment, right? Bonds payable will go down, cash will go out, $100,000. And so if we reduce our bonds payable $100,000, then the liability is gone by the end of the 5th year. Okay, so let's look at what happened. So today, right at the very beginning, this company borrows $100,000. And it will pay back that 100 plus interest, right? 8,000 times 5 years is $40,000. So it'll pay back $140,000. And so we know the difference between what I borrow and I pay back is $40,000, and that's our interest cost. And if I were to add up that interest expense here, you know, I'd see, yeah, it's $40,000. And so those two are going to agree. It's just a sec. So we can see the $40,000 on our schedule agrees with this shortcut version, you know, comparing what I borrow and what I pay back, the difference is interest. Okay, now the thing, in this case, the bond functioned very much like a note payable where we pay interest payments. And it's really very straightforward and pretty easy to understand. However, that's not always the case with bonds. Because here's the thing. The bond contract may be drawn up in November. And so the company will actually draw up these contracts. And they'll have a bunch of them, and it'll always state principal, interest rate, and time. Principal, interest rate, and time. So those are typical things that have to be identified on any debt contract. Well, that's in November, and so the company locks into that. But they're going to have to go to the market. Well, there really are two variables when you go to the bond market. One of those is interest rates. Interest rates fluctuate daily. And then secondly are prices. And we're going to look today at how those two are interrelated. So the thing is that these contracts are drawn up. So the contract obligates the company to make these payments in the future, right? 8% a year for 5 years, and then this lump sum principal payment at the end of the bond. Now, when the company takes the bonds into the market, they only pay 98. So they only pay 98% of the face value. Now in this case, I had a face value of $100,000. So they're going to pay, or we're going to sell these bonds for $98,000. So let's go here. The amount we borrow today is only $98,000, right? We intended to borrow $100,000, but when we went to the market, nobody would pay us $100,000 for these bonds, and we only got $98,000. Okay, so we didn't quite get all that we wanted. Now, we're not going to go through the calculations because your author sort of bypasses that. But if we were to calculate the interest rate, I will just tell you it would be 8.51% would be the market. When we sold these bonds, the market rate was 8.51%. So what happened is that we can see that interest rates in November were 8% when we drew up our contract, but they went up, right? Interest rates went up by the time we sold the bonds in January, or issued the bonds in January. And so what the market does to offset that is reduce prices. So we only got $98,000 for a bond. So in substance, so here's our legal form. Here's our legal form of the contract. But in substance, we borrowed $98,000 at 8.51%. Okay, we didn't get $100,000 at 8%. We're really getting $98,000, and the payback terms at $98,000 for 8.5% is this. Okay, so what we saw, the face rate is 8%. That's less than the effective market rate of 8.51%. And the face amount of $100,000 exceed the market price of $98,000. So there is an inverse relationship between interest rates and bond prices. Okay, so let's look at our journal entry. So when the bond sells at a discount, which we saw here, all you're going to need to know is this original journal entry. So what happened is they borrowed $98,000. We're going to put the face amount in the bonds payable. Those don't equal, obviously, because the bond sold at a discount. And this discount on BP, that means bonds payable. So the discount on bonds payable, it's a contra liability account. It's a contra liability account. So if we were to look at the balance sheet after this entry, right, in liabilities, we would have bonds payable under long-term liabilities of $100,000, and we would subtract the discount on bonds payable, $2,000. And then we would net that to have a net liability. It's going to abbreviate liability, a net liability of $98,000. So our liability reflects $98,000 because that's the cash that came in. Okay, that's when they sell at a discount. Let's go look at the other possibility. So again, the same contract terms as we've seen in the other demo. So we lock in contractually, we promise to pay future bondholders these cash payments in the future. When we went to the market though, the market rate was 7.02%. And again, we're going to bypass all these calculations. So when we go to the market, I'll just give you the price, we're not going to calculate it, was $104,000. So I'll just give that to you, and the textbook will as well. We're not going to calculate the price. You're just going to be told the price. So in essence then, instead of $100,000, we end up borrowing $104,000. So we borrow today $104,000. So let's look at what happened. Even though the face rate is 8%, when we went to the market rates had gone down. The face amount then is going to be the opposite. So here, $104,000. Or we'll go up here and I can show you the same thing. So here's our formula for interest. Time stays the same, so it's not a variable. But rates went down, so prices adjust by going up to keep that in equilibrium. Okay, so then our journal entry, we actually get $104,000 for the bond. We put the face amount, right, the contract amount of the bond, principal. And this time to balance, we have a premium. And that premium on bonds payable is actually an additional liability account. It's an additional liability account. So this time, when we go to the balance sheet after this journal entry, we would have bonds payable, right? Its balance of $100,000, right? Its balance of $100,000, and we will add in the additional liability of the premium on bonds payable. The premium on bonds payable, and we would add in that balance of $4,000, right? We credited it for. So this time, our net liability, which represents the amount we borrowed, is $104,000 net liability.